Hello, listeners, and welcome back to another episode of Cognitive Dissidence. As usual, I'm your host. I'm Jacob Shapiro. I'm also a partner and the director of geopolitical analysis at Cognitive Investments. Rob is back in action for our weekly chat. I'm recording here from Kansas City, Missouri, where I just spoke at FarmCon conference. I'm going to go spend the rest of the day at the Truman Presidential Library and then drive up to St. Joe, where my grandmother was born, although I've never been there, and check it out before flying back home to New Orleans later tonight. Maybe I'll tell you some stories about that on next week's podcast. But we're glad to be back podcasting with you in the new year. Thanks so much for all the support and reviews that have come in. Keep them coming. If you have comments about this podcast or about what we do at Cognitive Investments, write to me at jacob@cognitive.investments. Otherwise, cheers and see you out there. Cognitive Investments LLC is a registered investment advisor. Advisory services are only offered to clients or prospective clients where Cognitive and its representatives are properly licensed or exempt from licensure. For additional information, please visit our website at www.cognitive.investments. The information provided is for educational and informational purposes only and does not constitute investment advice, and it should not be relied on as such. It should not be considered a solicitation to buy or an offer to sell a security. It does not take into account any investor's particular investment objectives, strategies, tax status, or investment horizon. You should consult your attorney or tax advisor. Rob, I want to ask you something half in jest and half seriously. I'm at this conference, FarmCon, spoke here yesterday in Kansas City, going to wander around Kansas City and St. Joe later today. The coffee that's being provided at the conference is from Starbucks. And people may have heard me rant about this before, but I don't understand how Starbucks makes money as a business because their coffee is reprehensible. It's absolutely disgusting. So I have actually been going down to the really nice coffee shop in the lobby of the hotel to buy coffee because I can't drink the swill that is coming out of these Starbucks canisters that is everywhere. As somebody who is a short seller, tell me why Starbucks exists as a company. How is this the experience of coffee that people have in the world? Is it because they don't drink coffee and they just want these stupid sugary drinks? Can you please give me a sanity check here? It's driving me nuts.
Yeah, I mean, that's totally it. I agree. The Starbucks coffee is bitter. It tastes weird. I never drink it. It's terrible.
Makes my stomach feel bad. Like it's awful. It's really disgusting.
No, but as a short seller, I would caution you against Starbucks because most people aren't going there for the coffee per se, and it's an extremely high return on capital business to have a coffee shop. Coffee is very high margin, so don't vote with your taste buds.
It's funny you say that. You always tell me what your friend said about one of his investing rules was always never short fat people. And when I was here at the conference, somebody was talking to me about this great fund that they were trying to assemble that was going to focus on nutrition because the United States wastes $1.9 trillion, I think was his figure a year, on health-related conditions related to obesity and bad nutrition. And if you can just improve nutrition, then you'd be able to fix healthcare and all these other things. So they wanted to put together some kind of fund or some kind of structure around investing in companies that are making foods more nutritious. And I didn't have the balls to say it to his face, but in my head, I was just hearing the never short fat people, man. Like, I don't like, this is not going to work. Like, great for you. I hope this works. Like, it'd be good for the country, but I don't see it.
Sounds like a financial disaster in the making.
Yeah, which well, on that happy optimistic note, usually listeners, Rob and I get on the horn here before we get on and we decide what we're going to talk about. And it is a fairly quiet week, but I think it's a deceptively quiet week. I think people are coming off the holiday and just kind of, slowly easing back into global news flow. I also think just about everything we're seeing, at least in this first week of the year, is kind of vindicating some of the stuff I put out in our CI forecast for 2023, which is everything is dominated by the United States right now. Front pages are all how many votes are we going to get in the House before we get a speaker. And I think it's obscuring sort of some things along the edges. The first we already sort of stepped on, but I think it sort of bears noting because this is another place where I'm feeling a lot of complacency. European natural gas prices are where they were before Russia invaded Ukraine. less than 12 months since Russia invaded Ukraine. The war is still on, and yet natural gas prices are back to where they were before. And I just think it's worth pausing on that because it's remarkable. It's remarkable sort of how fast things went back to normal. It's remarkable how this narrative about a European energy crisis and people, dying of exposure and cold in the European streets has completely evaporated. Now, some of that is due to favorable weather, far more favorable weather than even I thought was possible. But things are going fine. The Germans have been able to do everything they need to do. Even the Central European states that I was particularly worried about, like Slovakia and Hungary, they're not really having any problems either. But lurking beneath all this is the fact that the war is still on. We're getting these sort of blips in headlines of Russia bombing Kyiv or bombing civilian infrastructure in Ukraine, and then Ukrainians, making speeches or trying to bomb things in return. But the fact of the matter is that the ground is just not very good for military conflict right now. And I hear this narrative going up that people think there's going to be a negotiation. There was this suggestion when apparently Putin says now that Russians can accept foreign currency from non-friendly countries again for natural gas exports. That I think also tells you the kind of economic pressure that Russia's under. But I think there's this general sense that, this is the new normal, everything's going to be fine. And I just don't think I don't think that's true. I think the Ukrainians are scrambling to get as many weapons and ammunition ready for the next onslaught as they possibly can. And it seems to me that the Russians are mobilizing as much as they possibly can to try and push and win this war, because I don't see that Putin is going to tolerate losing it. So I think we'll sort of pick a bunch of different places around the world to talk about why it seems quiet, but why it's really not. But that was just kind of the first thing that came to mind for me about what's going on in Europe right now.
Yeah, and tying that into the economic data, the inflation numbers for France and Germany were released this week for the month of December, and both of them came in meaningfully lower than expectations. And in France in particular, this was driven by energy costs for the most part. So if you strip out energy and strip out food and look at the so-called core inflation measure, it's much steadier than that. But even within the core inflation measure, in France in particular, the services inflation was meaningfully below what people expected. So the onus has, I think, fallen a little bit on the ECB to get really tough, and especially with natural gas prices where they are now, that whole calculation seems to be changing a bit.
And speaking of inflation, maybe we can hop over to the one country in the world that I don't want to say seems positively giddy, because I don't think Japan ever appears positively emotional about anything, but it looks like Japan has some inflation. There apparently even the Bank of Japan is changing kind of the way that it measures inflation, trying to strip out fuel costs to get to something that they're calling core inflation or something like that. But we talked a lot about this in sort of our last weekly update. But I think it bears mentioning that there have been a couple updates on the Japan front. So why don't I tee you up for that? Because I think it ties directly into what you were talking about with the inflation numbers in France and Germany. It's sort of the other side of the coin in a sense. It's like Japan's a weird twilight world for the global economy.
Well, I think I want to talk about Japan, but I think this ties into a broader theme with all of the major central banks right now, which is how much weight do you put on sort of core measures of inflation versus headline or, whatever calculation you want to look at, because this is the issue with the U.S. Federal Reserve also, is they're focused on labor inflation within the number, particularly services, particularly leisure and sort of low-level services. So the irony is, what is your definition of transitory? What are you really focused on? What are you willing to ignore because the thing that you care about is not doing what you expect? And that's the issue, moving it back to Japan, that's obviously in play here, because Japan, their rate of overall inflation even is much lower. Core inflation was 3.7 in the last print. And we talked about this in the last market check-in. But since then, interestingly, Kuroda, the head of the BOJ, has come out and given a very interesting speech and a very clear speech. Now, remember, the background to this is that almost all market participants think he's full of shit. They all think that he is starting to set the table for a meaningful change in the approach to monetary policy, and that he's dragging his feet, and they're going to try to make him do what they think he has to do. So if you look at the numbers right now, there's a battle going on. The BOJ is spending massive amounts to buy JGBs, Japanese government bonds, to keep them pinned to the level that they just raised, but which now, they've marked out as the ceiling for how much they want it to fluctuate. So the markets are trying to call the JGB's bluff. In a similar way, everyone knows about George Soros breaking the pound. It's a similar dynamic to what he was trying to do back then, viewing the bank as being in an untenable situation, viewing them as having limited firepower to keep it up indefinitely, and realizing that the more they pile on, when that snaps, you get a big payday. And of course, everyone's been trying to mimic George Soros for the past 30 years. So I think that plays into it as well, because it's the most famous trade in history. But anyway, in this speech, Kuroda, I think, really said some interesting things where, first of all, he flat out said, look, we are not changing anything. I cannot repeat that enough. It's basically just said it straight out. But then the thing that I found interesting about the speech, and the version I read was translated into English, so I don't know what the Japanese equivalent is, but over and over again in the speech, he uses this sort of terminology where he says, our goal is to get inflation rates, at our target in a sustainable way with wage increases, to get the price to where we want it with wage increases. And he says this over and over and over again. And even if you look at his recent speeches, he's spoken many times about wages and wanting to see that virtuous cycle kick into gear, but really never to this level of repetition. Almost my read of it, and maybe this is too far of a speculation, is that it's almost like he's trying to define that as his mandate now. Our mandate is to do this with the wage increases. And if we don't get those wage increases, then the mandate is not fulfilled. And that's a really subtle and maybe kind of boring, but utterly important thing, because what he's trying to say is we're right on the brink of accomplishing what we have been trying to do for so long. And we're looking at the Shunto wage negotiations that are coming this spring, and God damn it, you better raise those wages. And we want to see that kicking this into gear, right? So I think he probably sprung that big surprise during the holiday week to juice the yen up, because they don't want the yen to depreciate too quickly. That causes problems for them. But at the same time, I think it's pretty clear that they're not going to take their foot off the gas until you really see this virtuous cycle kick into gear, and all of the, deflationary forces that they've been dealing with, and deflationary expectations they've been dealing with for 3 decades, get wiped away and a new regime start.
One of the things that stood out to me in what you just said and what I've been reading about this was these wage negotiations that are going to happen here in the spring between Japanese companies and between Japanese labor unions. And I guess the question I would throw back at you is, do you think at least some of his bravado, it seems to be, that he definitely wants wages to be hiked, and he wants wages to be hiked above inflation and things like that. But do you think if he got a wage hike above inflation, that one wage hike would do it, that we could begin to talk about mission accomplished and then say, okay, we've done what we established we've done what we set out to do. Now we sort of need to turn back a bit? Or do you think this is the sort of thing where Kuroda and then whoever succeeds him wants to see multiple years, wants to see a trend line of wages going up before they're going to take their foot off the gas pedal? I guess I'm just asking about sort of timing in your mind, about how long you think Japan's going to stick to its guns, and what somebody like Kuroda would need to change his mind, or say that, hey, we need to move to the next stage of whatever we're doing to repair the Japanese economy.
I think if you get a situation where nominal wage growth is accelerating, and as long as inflation is not outpacing it by a meaningful amount, they're going to keep revving the engine for as long as, you have to remember, this is 30 years of a process that they're trying to reverse. And it's not a mechanical process, it's a psychological and social one. They're trying to change the mentality of everybody to not expect prices to go down, to not expect that their wages won't go up in the next year, to not expect that they shouldn't invest and hoard labor rather than slash it whenever things start to turn south. That's a long process, and I think they very much recognize that.
Well, the flip side is that a long process? Because I feel like sometimes that sort of monumental change happens quickly in someone's minds. Like in some, like, I don't think you're going to get incremental change sort of from that perspective. Like I mean, a good example of this is in the United States. We've had basically zero or negative interest rates for over a decade, and everybody got used to it. And then the speed with which everybody was like, oh my God, inflation, we have to hike rates. I mean, that happened really quickly. So I do think that with everything that's happening in the world right now, and especially Japan experiences China's problems, I think, much more acutely than we do in the United States. And you know, Japan also just had their longest serving leader. I can't remember, was Abe the longest serving leader since World War II or the second longest? I forget, but he was there for a long time in this huge symbol, gunned down in the street as he's campaigning. So I think there is something to say that maybe it's not incremental change. Maybe Kuroda sees that he has an opportunity in the Japanese psyche to say, this is a moment where things are more malleable than usual, because we've been trying for 30 years to fix this thing and nobody listens because everybody's been stuck in their ways. And you can't be stuck in your ways if you're paying any attention to what's going on in the rest of the world right now.
Well, I think that's really important. And that's why geopolitics are such a key aspect of this, because a lot of this didn't start to change until, you know, in the last 7 or 8 years. You started to see glimmers of investment starting to accelerate again, and Japanese businesses starting to, you know, borrow and spend again. Not in a huge way, but that did coincide with China's rise, Japan's kind of growing insecurity, a lot of these geopolitical imperatives that you talk about so much coming more to the forefront. And of course, having your second longest serving prime minister gunned down is not going to create a sense of stability. That's for sure. So there's those tectonic plates behind it. But, you know, unlike in the US where, and again, like, we're very driven by what does the median voter want? Like, that's truly how things tend to go here. And the median voter is very fickle, because you're talking about a household, you know, inflation goes up. We say, oh, you idiots, inflation. You know, we go into a big recession. Oh, you idiots, unemployment. You know, and then, you know, we seesaw off in response. Japan doesn't work nearly the same way. And the people whose sort of psychology they're trying to change are primarily large corporations. And if you read Kuroda's speech, getting into the nitty gritty, it's kind of interesting because he talks about the two-tier labor market and how it functions very differently. So the wage increases that they have seen in recent years are for non-permanent employees. So like contract labor, people on short-term contracts, younger people, that sort of thing. Like there's more job switching there. There's more of a dynamic where you can get wages increasing, whereas the permanent employee base, which is still like 70% of all labor in Japan, hasn't really seen that to nearly the same extent. So he wants to get the big behemoth dinosaur Japanese corporations to say, oh shit, like the world is changed now, and now we have to operate with more urgency, operate in a different way. And that's, you know, these guys don't change their minds overnight.
Yeah. I think that's a nice segue into the other sort of shoe that I think everyone is, I don't want to say waiting to drop, but that's probably the wrong metaphor to use here. But it does feel like everybody's watching China right now and trying to understand what's going on with the COVID-19 situation in China. And I'm with them. I mean, it's a huge challenge, I think, to Xi Jinping's legitimacy, and it's a major challenge to the Chinese healthcare system. And it's very easy to dream up scenarios of how a healthcare system collapse in China or some new variant, because now, you know, 1 billion Chinese people are being exposed to the virus. Like all that doomsday stuff is there. But something came out earlier this week that really caused me to stop in my tracks, and it was a Bloomberg report, and they're sourcing top officials. So let's take it with a grain of salt here. But the report said that China was going to pause massive investments aimed at building its domestic semiconductor industry. That it also, in general, that Chinese officials were not really satisfied with the way that they've tried to help homegrown chip makers grow. That this sort of capital intensive or capital investment heavy approach that's worked so well in propelling other parts of its manufacturing sector over the past few decades, that it just doesn't seem to be working for the chip makers, and that there needs to be some kind of change in the policies that China's going to use, because all they've gotten right now is they've spent a lot of money on basically nothing and had no progress, and they've gotten all these U.S. sanctions. And that report just kind of, it stopped me in my tracks a little bit, because number one, the semiconductor restrictions really do sort of show how the United States is still the most powerful country in the world. And the United States seems to have been able to get Japan, even the Netherlands, at least the Dutch government. It's not clear what ASML is going to be doing. But at least has been getting some of these other countries to sign on to its semiconductor restrictions just with the threat of U.S. sanctions, or just with the threat of the U.S. not being happy. It's been able to really undercut some of China's major goals for itself. I mean, China was ahead in the 5G race before the trade war on Huawei. I feel like it's starting to fall behind, or at least it has lost its advantage in general. But the reason I wanted to bring it up was because I'm here at this conference in Kansas City, and the speaker who came on before me talked about how this was the end of the Chinese Communist Party, and this will be the last decade where the Chinese Communist Party rules, and was comparing Xi Jinping to Mao, and about how nobody wants to bring Xi Jinping information, and that this is the Great Leap Forward all over again. And I don't see that. I see a China that is struggling and flailing around trying to find the right policy approach, but it's flailing. It recognizes when things aren't working and is changing policy. I think that's something that kind of at least pause and watch with. It doesn't mean anything good for the Chinese economy kind of going forward here in the next year. I think it also goes to the sense that you can have a capital investment heavy approach if you're, making umbrellas or making furniture or trying to do packaging for low end things. That doesn't really work when you're starting to get to the commanding heights of the tech economy. But I just didn't want that story to go unnoticed in all of the sort of COVID fascination that's happening with China right now, which is a little dread to me, to be honest.
I mean, it seems like a positive sign if that is indeed what's happening, because it is a symbol that they're engaging in capital discipline. Like we've talked about with the East Asian model, which is top-down driven, and where do you allocate capital? Where do you, get efficiency? That requires the discipline to, cut it off when it's not working and go to something else. So that's a fairly positive sign, I guess. If, who knows? There's so much noise around what's going on. Maybe we're getting mixed signals, but if true, it would be not a bad thing.
Yeah. Well, we don't have to dwell too long on that, but I just wanted to sort of give it a little bit of time. As we dig into sort of a couple of other things that are sort of happening, I thought we might spend a couple minutes just talking about copper, Rob, because you were seeing some things in copper and asked me to do, and based on what you were seeing, asked me to go do some research. So I did my research. So why don't you tell the listeners what you saw and what my directive was, and I'll tell them what I found.
I'll tell them what your homework assignment was, and then you can give your book report.
Exactly.
So why copper? Why is copper maybe interesting? Really two things. The first is, whenever we look for opportunities in macro markets, we look first and foremost for divergences. So when you watch everything moving, what is the odd man out? When something is doing something different or weird, oftentimes that has informational value. So in this case, and that's especially true when you're looking across different markets, bonds, commodities, equities, currencies, that sort of thing. In this case, the thing that caught my eye was that copper prices bottomed in July, and all the other industrial metals, people talk about Dr. Copper as being the number one indicator of where the global economy is going, blah, blah, blah. all the other industrial metals continued bleeding lower over the same time period. So if you were to look at like steel prices in the US, right? So they moved down with copper in July. Copper put in a bottom, dug in, and has kind of been lifting its way slowly out of that trough since the summer. Steel prices just fell through it and have been making kind of consistent new lows since then until just very recently. So that's a really notable divergence, because if you thought there was a global growth slowdown happening, and especially because China was effectively shut down during that time period, that copper should have moved down with the rest of it, but it didn't, which is kind of interesting. The second thing is, we have really two huge drivers of copper at the margin right now. The first is Chinese fixed investment of all sorts, which we've talked about ad nauseum, and which I still think we're much more concerned than the average person who's not, Cato the Elder, the most important thing in the world is the Chinese property investment bubble.
It only took 25 minutes for him to get there in the podcast. So if you guys have the drinking game at home, I guess take your drinks now.
So you have my hobby horse on the one hand, and then you have, on the other hand, the growth in renewable build out. And if you look at the numbers on the renewable side, like that's getting pretty darn big. Not only in the US, which we all kind of know about with the IRA and, all of the projects that are being announced there, but also in China itself, which is building just an ungodly amount of renewable energy capacity in the next couple of years. And even India, which, I mentioned this to you before, and I think you thought it might be total bullshit. But even they're coming out and saying we're going to build 180 gigawatts, I think, of renewable energy capacity in the next 7 years. So I don't know how those two sides of the pendulum balance out. But the price of copper is telling us something interesting. So that's what I asked Jacob to investigate.
When you said the IRA in the United States, my brain immediately went to, is the Irish Republican Army causing problems in the United States? Is there some kind of sleeper cell in the and then I realized you're talking about the Inflation Reduction Act. As for India, I do think I don't think it's bullshit that they want to do that and that they want everybody to think they're doing that so they can attract foreign investment dollars. But I mean, that's sort of what I say in jest, but in all seriousness, it's a big deal, because if India can follow through even 75% of that goal, then we shouldn't be bearish about India at all. Then India is really a place that you want to be, I think, for the decade ahead. Everything that I've seen out of India over the past couple of years tells me they're not going to be able to do it, because for decades, they've known exactly what types of infrastructure they need to become the next China. I mean, and they haven't been able to build it. They have not been able to build the roads and the rail and the storage capacity and all the other things that they would need to become that kind of global economic power, not to mention their entire water system and what they've been doing in terms of shirking water infrastructure and just using up groundwater. So all of that tells me that they probably won't be able to do it. But if we see signs that they're able to translate those types of lofty promises into real action, in all seriousness, like, we need to stop and think about what we're doing. And India might be one of the biggest opportunities in the world. As it pertains to copper, when you sort of asked me to look at copper is something I sort of keep an eye on in general. And copper is interesting also because, we've been using copper as human beings for literally thousands of years. This is not, one of those new minerals. Like, I don't think they were using rare earth elements in Sumeria or in ancient Egypt or something like that. But copper's been around for a long time. And it's interesting because the things that we've used copper for have kind of changed over time. It's been everything from a means of exchange to being important for sheathing hulls on ships to being in wires that build houses. And now it's critical to the green energy transition. I think what's interesting, and one of the reasons that's interesting, is because we have lots of data about copper prices. So you can go back 200, 300 years and see what's happening with copper prices. And if you look at them that way, they've really been declining since roughly 1850. I mean, there are spikes when you get wars and there are spikes when certain things happen. But in general, the cost of copper has been going down over time because we have modern technology. We're getting better at mining it out of the ground. All these different things have been sort of driving the long-term price of copper down, which is one reason also, I think, why most investors stay away from commodities because it's not a buy and hold type thing. You really have to time things right. There are little blips in that, 200, 300 year chart of copper where if you'd bought at one point and sold at another point, you could be good. But if you had just held, you'd actually probably be down because you're on that sort of downward facing slope. The interesting thing about copper, to your point, is are we beginning to change that? And it's for two key reasons. The first you already alluded to. It looks like we're going to need a lot more copper in general for a lot of these energy projects that everybody has. So copper is super important for electric vehicles. You need about double the amount of copper in an electric vehicle as you need in a conventional vehicle. Copper is super important if you're building offshore or onshore wind. You need copper in a nuclear plant. You need copper if you're building even natural gas pipelines. You need copper for just about everything. And so we're going from, hey, we all used to use copper in using in buildings and things like that for the same use. And suddenly we have this massive demand that the market hasn't been accounting for and that there's not going to be supply for. Maybe you get this leg up. The more interesting thing, I think, and I'm not a geologist or an expert on this, but if you look at sort of some of the reports that are out there, it looks like the average grade of ore that is available to us, that is currently being mined, is really not so good. The quality of average grades of concentrate have begun to decline considerably over the last couple of years from the major copper producers. So that's places like Chile, Australia, Canada, and the United States to a lesser extent. And that means if you're banking on where we're going to find more copper in the future, it's places and markets that maybe haven't been tapped yet or where we haven't been doing a lot of copper mining. And that's when you get countries like the Democratic Republic of Congo again poking its head up. Indonesia, which is extremely protectionist about mineral commodities right now, is really jealously guarding all of its mineral commodity resources. Peru is another one that might be in there, but Peru, I mean, they've got protests again starting yesterday against their new president who replaced Pedro Castillo. So the map of where you're going to get copper from, the sort of traditional suspects have been seeing their ore grades decline, which means I don't know the right terminology here, but it takes more effort to get less good copper sort of out of the ground. And the places where you're going to find more copper, it's kind of scary to be there. I certainly wouldn't want to be there. And then the last sort of thing I'll say before I flip it back over to you is that there's a lot of disagreement out there about what copper prices are going to do this year. Chile's state Copper Commission, for instance, thinks that this is going to be a down year for copper. They think that the market is going to be fundamentally oversupplied, and they've been warning Chilean copper companies like, hey, like this is not going to be sort of the best year. You look at American investment banks, they're like rip-roaring ready to go. They think we're going to see record highs again, and that 2023 is really the beginning of a longer term, that super cycle word in copper in general. And the place where I land is that this might trigger your short selling brain, Rob, which is that everybody agrees that starting around 2025, demand is going to exceed supply, at least for a couple of years and maybe for longer than that. But that's 2025. And the debate is happening over, well, what's going to happen in 23 and 24? Is a global slowdown in growth and a recession in the United States and China's COVID problems, is that going to depress demand for copper enough so that you do get what the Chileans are talking about, where you're going to have a fundamentally oversupplied market? Or are all of these companies and countries, is India going to build its 180 gigawatts and they're going to want all of this copper, and suddenly the market is going to go is going to be unbalanced, or is going to be very, very tight sooner than people are expecting? So that's kind of the lay of the land and why people are focusing so much on 2023. And unfortunately, you can sort of make the argument either way. And I guess you sort of have to make the call now, because if you wait to 2025, probably by then people will have figured it out.
I think this is a case where there's an inefficiency in the market, in part because most market participants are not trained to look at price. So I'm a fundamental analyst. That's my training, looking at businesses and what's happening in the world. That's the fundamentals. But I'm also a chartered technician, which in my world, if you say that, it's like you say you're like an astrologer or something. Like people think you're ridiculous. But really, what that means is it just means that you're trained to look at the price action itself as being of importance. And I think that's really, really important And the reason why there's opportunities in deep cyclicals like commodities like copper and stuff like that, because the price starts to tip you off before the fundamentals change. And the opportunity exists because people wring their hands over these fundamental stories and, oh, what if there's a global slowdown in the meantime? And, 2024, 25, I don't know, how are you going to, like, sometimes you just have to shut up and look at the price. And the price is telling you at the margin where things are going. And I don't know if that's the case for copper yet, because it's a little premature. But the fact that prices, as I said, didn't continue going down after July and have been kind of notably perky, despite the fact that growth has slowed down almost everywhere in the world since then, that's a noteworthy sign. And I think, when you're thinking about, well, how do you set up these trades? How do you understand how to approach these things? If you're not looking at price and fundamentals and the conjunction between those two things, then it's like, you're going with one arm tied around your back.
Mm-hmm. Well, that makes me want to ask, and I don't know if you've looked at the chart recently, but have you looked at the chart for soybean prices lately?
Yes.
What is that? Are Mars and Jupiter in alignment for you on soybean prices? Tell me what the astrologer has to say about soybean prices, because based on what I've been hearing here, I have some stuff to say.
Well, I don't have the chart in front of me right now, but from what I remember looking at it yesterday, it's, I don't know, I don't find it particularly exciting, the chart. You peaked out closer to where the war, first broke out. You had a significant pullback, and now you're rebounding. I think the soybean price right now is like 1660 something. Is that right? I'm quoting from memory.
That sounds roughly right, but the listeners can tell us if we're wrong.
Yes. Which is sort of back close to the highs that you saw earlier in the year, when you first had the big disruption. So I don't know, like, you're sort of doing maybe a double top here. Everyone seems to be fundamentally very bulled up on soybeans, as you're hearing at this conference, it seems, and as we're hearing elsewhere. I don't know, it just makes me a little cautious.
Yeah, the reason I ask is because, again, there's a weird thing happening here between fundamentals and price. So the first thing is I think the reason we had the big run up in corn prices, in wheat prices, and soybean prices, it was the Russia-Ukraine war. It was an exogenous shock that everybody was sort of betting on that. And I will say that there were two sentences that have been said at the conference so far that I wrote down in my notebook that I thought were really notable. The first was, somebody said that based on their context on the ground in Ukraine, that there is no fertilizer in Ukraine. None. That they get all their fertilizer from Russia. They had enough to cover last year's growing season, but there's none there right now. And if the war doesn't stop and they don't get fertilizer, they're just not going to have fertilizer. That sort of told me, well, hey, you could see another Russia-Ukraine shock to grain prices if that's true, because Ukraine has great soil, but still, like, if you're not going to have any fertilizer whatsoever, and let's say the war is a little more, what's the right word I'm looking for here? If the war is a little more intense than people are expecting, sort of come May and June, maybe you could have a repeat of that trade again. Like that's probably not going to happen. I feel like no 2 years mimic each other quite that way, but I do think that's sort of in the cards. But the difference between something like corn, which Ukraine is a major exporter of, and wheat, and all these other things, and soybeans is that, and this is the other sentence that I circled, was that somebody at the conference said, this is the year of renewable diesel. And we've talked a little bit about renewable diesel and biodiesel on the podcast already, and I wrote about it a couple months ago. And I don't know that I'm ready, or that I have a view on which way this is going, but I do think that if you can kind of just put the Russia-Ukraine stuff aside on the price of grains, that what happens with renewable diesel is really the story here with soybeans. So if you're going to get this massive spike in demand for renewable diesel, whether that's because California mandates it as a certain percentage of their fuel, or whether people start using it as aviation fuel or things like that, then there is going to be this huge demand for soybeans. You're also going to get a lot of like excess soybean meal, because that's not used for renewable diesel and all these other oils. But then like soybean oil is going to be in demand, and we're going to be planting soybean acres because farmers are going to want to sell or get the credits that come with creating that renewable diesel. So like that was sort of what the big panelists were saying, and I some of them were bullish and some of them were bearish. The couple farmers that I managed to talk to told me they weren't really changing what they were planting right now. They were all looking, they were all reading, they were all trying to figure out what was going on with sort of renewable diesel, but they weren't at a situation yet where they were actually sort of pivoting. But yeah, I keep on coming back to this renewable diesel question and whether it's going to take off. And the last thing I'll say is that the EPA put out targets for sort of renewable diesel and biofuels production and things like that in November, and they surprised to the downside. I think people were expecting much larger quotas, and the EPA didn't really put them in. And there's been somewhat of a backlash to that. And so the EPA is supposed to be hearing, I guess, objections, or there's going to be hearings on the draft in February, and then there'll be some kind of final ruling in June and July. And again, here, one of the interesting things is the companies that are investing in this theme, so that are building crushing facilities in places like North Dakota, they're not blinking. They're full speed ahead, hundreds of millions of dollars. U.S. energy majors, Bunge, Chevron, all these guys are still thinking that this is the big theme. And then in some sense, if they create the renewable diesel, like, it will be used, because you're not going to get a U.S. government that is going to turn its nose at all of this because of what it would do to farmers and what it would do for energy security in general. So you can sort of hear me hemming and hawing and sort of which way to go in the thing. But I do think that this is one case where if you have a view on renewable diesel and you feel good about it, soybeans is probably the place to express that view in the year ahead. And if what that guy said, if this is the year of renewable diesel, then yeah, like, you should probably be thinking about soybeans long, because the old fundamentals don't work anymore. Like, it's a completely new fundamental realm if that's the direction we're going towards.
Yeah, it's really hard to gauge. And here I'm just displaying my biases, because I find it very difficult to enter a position when it's not a very contrarian entry. You know what I mean? Maybe the EPA thing creates an opportunity. And that's really stupid of me, because frankly, like, sometimes you just have to find something that's going and get on board, and you don't have to overthink it. But I'm just constitutionally, I just struggle when other people really like something to get, like, to get very excited about it. Particularly in commodities. I find that commodities are fundamentally one of the most efficient markets, because the information around them is so well disseminated. Like, for example, we do equity work, and we have for a long time. Equities are not nearly as informationally efficient as you would assume. Like, you can go find a company, find a stock, do research on it, and find things. If you're just willing to do field research, go talk to people, and you find things about the company that are not publicly known or not obvious, like big, important, fundamental things that make a big difference. That's really hard in commodities. You have like ADM and Bunge and, Cargill, like, they are everywhere, and they have people literally just like, counting every bean pod and using satellite imagery. And, there's only like 8 things that you have to watch. So you can scale up your resources to really, like, okay, everything related to soybeans, we're going to have 150 people just doing this thing. And that's economically makes sense as an organization to do. So it's, maybe it is a good trade, and it's, soybeans could double from here. I have no idea. But personally, the way that we do things tactically, I just find that hard. If there's not a sort of big divergence between fundamentals and sentiment, or some sort of thing to hang your hat on, as a trade, it's a trickier one, at least according to our style.
Well, no, and the reason I wanted to bring it up is because, and and listeners, you'll probably tell, like, neither Rob nor I are experts at these things. We are both deep generalists who, in the course of our other research, come across these interesting opportunities and furiously learn as much as we can, as fast as we can, about something that we think could be a potential opportunity. I know for a fact there are people listening to this podcast who will have forgotten more about renewable diesel and soybeans than I will ever learn in my entire lifetime. So if anything here sets off alarm bells for you, please write in. Please tell me how stupid I am and how wrong I am and what things that I should be reading. I will not take it personally. If anything, I will thank you for it. But the reason I thought it was good to bring it up was because it seems to me that you're not seeing the sort of price action that piques your interest, Rob. Whereas it interests me because with copper, the fundamental story is that, hey, we're moving from a global market for copper where there's a major change in what people use copper for. We're going from, hey, copper's used in construction to, wow, copper is going to be used in all of these different energy applications that are completely new and that it's really hard for people to benchmark. And the better you are at anticipating what copper demand is going to be based on those energy applications, the better you're going to be able to make informed decisions about what the price of copper is going to do. It seems to me like soybeans, it's not necessarily as clear. Like, it is not as clear that we're going to get a huge spike in renewable diesel here, production or even demand over the next 2 to 3 years. But it's an idea that's out there in the ether. And if you did get that, if somebody like Dan Bass, who's been on this podcast, is right and says that the United States is going to need another 10 million acres of soybeans out to 2026 to meet the demand for renewable diesel, like, if that's true, then soybeans are undergoing a shift, kind of like what corn did around ethanol. And you'll just see this massive shift in the market. And maybe you have this short period between when everybody who knows everything about it today, just because they know about it today doesn't mean they know what's going to happen tomorrow if you get that kind of fundamental shift. But it sounds to me like the takeaway is you don't see in the price action enough evidence that's what's happening. Is that a fair way to sum up kind of what you're seeing on your end?
Well, I think there's always a time arbitrage opportunity in these things. And I think that's the case with copper, for example, where you have a long-term, fundamentally, potentially very bullish story. But in the short term, people are really worried about short-term things. And even though they may know the long-term story, they don't have the mandate to invest on that time horizon. They have the mandate to, hey, make money in the next 3 months. And in the next 3 months, we're worried about XYZ. Similarly, like in 2020, remember when we did the lithium? And, at that point, it's hard to even remember now, but we were all bowled up on lithium. And, at that point, believe it or not, lithium was absolutely in the tank. And the long-term bull story on lithium is pretty obvious. And the reason why it was in the tank was because the short-term fundamentals sucked. There was way too much supply and demand had fallen off because of COVID and everything. And, it was the same sort of thing. We're like, yeah, it's not rocket science. We're never going to have some hugely differentiated view on lithium 5 years out. It's just kind of taking advantage of the time arbitrage. People cannot own something, with a certain time horizon sometimes. And bringing it back to the soybeans, like, this is why I say, well, maybe the EPA thing is kind of interesting. But I don't really see much weakness in soybeans. Like, even though this EPA thing has kind of thrown a monkey wrench in the thesis, like, soybeans have just kind of plowed through it, and maybe that's a bullish sign. But I don't really see like where is your entry point? Like, it's just kind of a momentum thing, and I feel worried that if something should go wrong with that, like, that obvious, fundamental story, which, like, it makes so much sense. Yes, tell me more. Like, I always just worry about that because you get a data point out of the EPA, they didn't do it like we thought. And then the bottom falls out for whatever reason. It's just all about risk reward. And
well, and to your point, it's all cyclical. Like, the reason that soybean prices and corn prices are at their current levels is because of the Russia-Ukraine war. Like, I don't because it's a cyclical market and it's year to year sort of thing. Like, just because this broader story, it might be completely true. But right now, like, different farmers, they're still dealing with the aftermath of the Russia-Ukraine war, and a war that is completely uncertain. So to your point, like, if something happens with the Russia-Ukraine war, either positively or negatively, that's probably going to drive the price, I would think, here much more over the next 6 to 12 months than sort of these, talismans that we're trying to trace of a renewable energy future.
Yeah. So like, for instance, if you had a shocking end to the Russia-Ukraine war tomorrow, and all of a sudden game on for Ukrainian agricultural supply, and then soybeans, craps the bed because everyone's taking that into account, that could be a really interesting entry based on that longer term story about biodiesel and that sort of thing. It's tricky because I think our audience is combined of people who care about fundamentals because they're running businesses, they're running farms, they're, doing things in the real world. And then people like me who, have to think about fundamentals plus what are the markets saying about the fundamentals and finding that arbitrage. And so it's not to say that
And don't forget the people like me who just love crafting macro narratives and have to be brought down to earth by people like you. So,
but it's not being brought down to earth because the fundamental story that you're telling, like, that's not incorrect. Like, it's an interesting story. It's not widely enough recognized. How that's perceived in the magnifying glass of market expectations is a trickier prospect.
Yeah, all comes down to timing. Anything else on your mind, Rob, before we say goodbye to the listeners?
No, I don't think so. Those are the big things for right now.
Yeah, I want to just close by saying one thing. We can even riff about it a little bit, which is, and I'm almost going to critique ourselves a little bit here because we've talked about Europe, Japan, China, copper, soybeans. And in general, I think people focus on geopolitics. They're thinking about Eurasia for the right reasons, like China, Taiwan, and Russia, Ukraine, and the European Union, all these other big things. And those are the big stories, and they affect things more globally. But I think Latin America is really, really important. And I think there's a lot of important opportunities in Latin America. And I think over the last couple months, I at least have gotten away from focusing more on Latin America because there has been so much craziness sort of in the rest of the world. But to the extent that anybody talks about Latin America, it's, oh God, like Pedro Castillo and a coup in Peru, or, oh God, communist Lula is back in Brazil, or crazy guy in Mexico. And sort of one of my New Year's resolutions is going to be to roll up my sleeves and get back into Latin America. And I know from listener data and from having done this for years that people say that they're interested in that stuff, but that some people glaze over as soon as you actually start talking about Latin America. So apologies in advance to those of you who are going to get bored by that. But I think, Rob, that we need to challenge ourselves here to spending a little bit more time on, I mean, you and I talk about Brazil a fair amount, but South America, Latin America, it's a huge market. It's a huge opportunity. If we're right about our macro perspectives, like, it should be a part of the world that does really well and is not exposed to the same kind of systemic geopolitical risk that is in the rest of the world. I think we need to do a better job of sort of highlighting some of the things that are going on there, because I think that is a place where we could have an edge, because nobody really talks about it. To the extent they talk about it, it seems to me to be fairly superficial. And I say that in part because, again, like at this conference, I mean, I was surprised at the amount of focus on Brazil. People here were just quaking their boots about the level of agricultural production that Brazil is kind of teeing up. But there's a lot more to Brazil than just agriculture, and there's a lot more to Latin America than just Brazil. So I'm saying that mostly for myself, to slap myself on the wrist. But if you want to riff on that at all, feel free.
Well, I'm always looking for an opportunity to think and talk about Brazil because I love Brazil. So I welcome that. But just on the topic of financial markets and prices telling you something that's important, we just finished 2022, which was one of the worst years for financial markets ever when you consider bonds and stocks going down together. Look at Brazil, look at Mexico, look at Chile. None of those markets were even, I don't even think any of them were negative last year. And they didn't rip or anything. But the fact that they outperformed the developed world and other emerging markets, like Southeast Asia looks like terrible. Just, to put that into context, it's not an emerging markets thing. It's a Latin America thing. That is really noteworthy. Look at the Mexican peso. What the heck is going on with the Mexican peso? I don't understand it. Every other currency on earth has gotten clobbered in the last 18 months, and the Mexican peso is beating all of them. Something is happening there that's good. And I think it's worth getting to the bottom of it.
Well, the Mexico story, I mean, this might be one where your contrarian instinct works against you, because it's, hey, U.S. companies can't depend on China anymore. Southeast Asia has a lot of risk and a lot of competition, and also a lot of the capacity for Southeast Asia is taken up. Like there are companies that bet on Vietnam 5-6 years ago. Those were good bets. There's no more spare capacity in Vietnam. Even if you wanted to move a large amount of your manufacturing to Vietnam, there's no room. They don't have the infrastructure to kind of handle it. So if you're an American company, or even a European company, like if you're looking for a place to de-risk and get away from Eurasia and get away from the Asia Pacific, your choices are Latin America and Sub-Saharan Africa, and one of those choices is much better than the other.
Yeah, that's true. One data point on Mexico that I saw in the last week, which is gonna, I hope, not get us in trouble, is the remittances number came out. I saw they release this every month, and remittances from from the US to Mexico have been growing at a torrid rate for the last decade. And I did a little digging into this because it's an interesting outlier, because immigration hasn't grown, and it actually was, fairly limited for a significant portion of the last decade. There's no demographic reason to expect why remittances would be up so much. And the peso wasn't even very weak, as I just pointed out. So it's kind of interesting. And I was reading an expert in remittances who was doing an interview on this, and he said, look, like, remittances are in many cases used for money laundering. And this is probably a sign that there's a significant growth in the amount of drug money being laundered, coming out of the US and going back into Mexico, which from other research we've done, like, I know for a fact that that's a huge industry. So I don't know if that's a good thing that the cartels are doing very well. I mean, they spend money too, or if it's a negative sign that, man, the cartels are really doing well, and that's a sign that underneath, the allure of manufacturing in Mexico, there's serious social problems that could rear their head. I don't know, but it's worth noting because that number has been off the charts.
Yeah, I don't care if this gets us in trouble, because it's an important and interesting conversation. I mean, I've been on a contrarian island here for, I don't know, I guess has it been 6 to 8 months now since I first started talking about this? It might even have been longer. The cartel wars really begin sort of under Calderon and sort of late 2000s. So I forget if it's 2007, 2008, exactly when the Mexican government decided that it wanted to declare war on the cartels. And what happened was they blew up these big cartels. And so you got a bunch of smaller cartels that started fighting both each other and the Mexican government for turf. And what's happened in the last year or two is that it's finally beginning to consolidate around big cartels again. So I think it's Sinaloa and CJ&G are sort of the biggest ones. And you still get some turf wars. Like, there's still parts of Mexico that are incredibly violent. But in general, if you look at the murder rates, if you look at the crime rates and things like that, they're still around record highs, but they're not going up appreciably. They've sort of plateaued around a certain level. And I have been wondering if we're going to see a drop going forward, because if you have a couple big cartels that are controlling everything, that should be a more stable system than a bunch of smaller cartels that are running around, fighting each other, trying to get turf from the other cartel and things like that. That doesn't necessarily mean good things if you are, a U.S. company and you're trying to move manufacturing to areas of Mexico that haven't already been focused on by U.S. industry. So, like, there are parts of Mexico that are close to the border that have unique ties to the United States where things are relatively safe. The opportunities in Mexico are in places where there is a lot of violence right now, but where labor is really cheap. And if you could have some kind of stable, rule of law and labor situation, and the violence could calm down to at least some kind of predictable level, like maybe you could sort of expand into those regions. So I'm rambling a little bit, but I think one thing to watch for there, and maybe I'll try and have a cartel expert come on the podcast during the next couple months, is are we moving towards domination of the cartel landscape by a couple big cartels. Is that good for cartel business? Is that also then good for the Mexican government? And then what does the Mexican government do in response? So AMLO, when he was elected, talked a big game about reconciliation and maybe he's going to legalize drugs. He did none of that. Instead, he has given the Mexican military an even more prominent role in Mexican life and in law and order in Mexican life. We've got Mexican elections coming up in a couple of years. Like who replaces AMLO, what kinds of policies they're going to do. If they're going to try to go all Calderon on the situation, that would be bad. From sort of a macro perspective, you might get, renewal of the cartel wars. If you're going to get somebody, though, who is more laissez-faire, maybe that could be good. What if you get somebody who's influenced by the cartels themselves? Like there's a lot of kind of uncertainty there, but that's where my mind goes. If your thesis there was right, maybe it's also a signal that the cartel war, as violent and as horrible as it is for people who are living in those zones of competition, maybe it's finally stabilizing into something that is, a little bit more of a predictable system.
So do you think that's positive in the minds of, multinational corporations that would be looking to locate manufacturing there? So if you're Samsung and you're like, okay, should we build another washing machine factory in the north of Mexico? And we understand that state capacity just doesn't exist in this area, or, but there's not a lot of violence. Do they go ahead with that? Is that a good thing? I don't, you've done consulting work with, businesses in this situation. So what do you think is their thought process around that?
I think that really depends on what you're manufacturing and where you're manufacturing and where you're manufacturing it in Mexico. So if Samsung wanted to build sort of a more advanced tech plant closer to the U.S. border and some of those corridors that have preferential access to U.S. customs and have security and are kind of not near the cartel wars, like yes, that's where everybody wants to be. That stuff is all kind of filled up. If you are on the lower end and you're trying to move shoe production or furniture production or something like that from China to Mexico, the industry is fairly nascent. It's all still mom and pop stuff. And a lot of the places where those specialties are located are in places that are incredibly violent, that are in those turf wars between different things. So in your example, it all depends where the washing machine sector industry is located in Mexico, how developed it is, how much security they have, how much of a track record they have, and then whether a foreign company is willing to go in there and be sort of the first mover to take the licks that's going to happen from being the first country on the ground there. The other part of this, and this is sort of much harder to figure out where this is going to go, is that as part of the new NAFTA, the U.S. Mexico Canada trade deal, there's a lot of labor reforms that Mexico promised that it was going to enforce, and it's a fundamental change in how Mexican politics works. Because before, the labor unions had really tight ties with the PRI, which was the dominant sort of Mexican. It was sort of single party rule there for almost a century underneath the PRI. And that's also begun to change as well. So now labor unions are becoming more independent. They're negotiating for their workers. It's U.S. companies. I can't remember whether it was GE or GM, but one of those companies sort of ran afoul of that because they had to do wage negotiations. The other thing with Mexico is sort of the boring, mundane aspects of Mexican labor reform, and whether they are depoliticizing that or whether labor unions just get held captive by Morena, or whether they go back, like all that sort of stuff really matters also if you're a company that's thinking about that. It's also a great, you can hear me talking about it, you can sort of hear, the list of risks that you sort of have to go through when you're thinking about Mexico. Just the two things to keep in mind, like with China, you didn't have to do that. Like this is what China was so good at. Like China had scale, China had authoritarian law and order, like everything was sort of set up for you there. You could just move in and have tremendous scale. And that was why so many people moved to China. It was because China outcompeted most of the rest of the developing world. What's changed now is that Chinese labor costs have gone up enough that people were already questioning whether they could stay in China long term and get the cost benefit. There's the geopolitical risks around China and the doubts about the Chinese government, and U.S. sanctions on the Chinese government and things like that. And then the other thing is that even if it costs more in Mexico, and even if it's more inefficient, and even if you don't have scale, it's much, much closer So, you don't have to wait 2, 3, 4 weeks that you might have to wait for a factory from China. So maybe you put some portion of your manufacturing in Mexico. You still have your things in Southeast Asia or in China, and you kind of piece it together that way. So that's always sort of the give and take there. Like in Mexico, the law and order situation and the scale situation, there's no evidence to think that is ever going to be competitive with a market like India or a market like China. If you're going there, it's because you're betting on the future and you're saying that proximity and time is worth more to me than kind of some of these other aspects. Because if you're just looking at sort of the actual like risks on the ground, like they're elevated in Mexico. You can't say that they're not there, especially when you start getting into that low end manufacturing.
Well, I don't have the FDI numbers for Mexico in front of me, so I can't speak to whether companies are actually accelerating any of their investment into the country. But just from the bottom up work that we do, looking at individual companies and what decisions they're making, I don't really see companies talking about building much capacity in Mexico. We see companies building stuff in South Carolina and North Carolina and rural Georgia and, out where you grew up, an hour east of Atlanta and then that sort of area, and building out the infrastructure to move that stuff around and warehousing and stuff like that. So if you had to say where they're, betting with their actual dollars, it seems like it's still kind of hypothetical to some extent.
Yeah, my sense is that people are talking about it, but haven't made the decisions quite yet. Yeah, I mean, people are thinking about and talking about Mexico, and they want the Mexico opportunity to be real, but there's a lot of doubt. I think that's also true of Brazil to a certain extent as well.
Yeah, but Brazil is much more I think Brazil has the scale to be more inward looking like the US is, whereas Mexico less so.
No, I mean, Mexico has a lot of work to do if it wants to really capitalize. But the flip side is that the opportunity is there for them. And I don't know if AMLO is the president to do it for Mexico. I mean, it's this political transition that's coming up is going to be really important. But yes, I mean, I take your point. Everybody's talking about Mexico. Mexico looks shiny in a lot of different ways. But when you start to sort of peel back the layers of the onion and go into, okay, well, what would it take to set up the factory and where would I have to go and who would I have to pay off and what do I have to do? Like, all that sort of stuff is a lot more complicated than it just might seem from the broader story. That said, like trade and things like I like the metaphor of water when it comes to these things. Like it will find cracks, it will find deficiencies, like it'll move from one portion to the other. So even if there are challenges within Mexico, there are also absolutely opportunities, especially if you are somebody that wants, secondary backup production in close proximity to the United States. Like those things kind of are there. And I do like there are U.S. companies that have bet big on Mexico and like think that Mexico is the answer going forward.
So we still don't know why the Mexican peso has been so strong.
But we riffed on this just because I was feeling sort of insecure about not focusing on Latin America. But we have our monthly country review coming up next week, and I think I'm going to spend the next couple of days thinking about Mexico in the context of that, and then maybe we can have a more robust discussion about it next week. Because either way, I think it's an interesting opportunity.
Shall we call it quits?
Yeah. Have they had enough? I got to go to the Harry Truman Library here and be a nerd. So,
Harry Truman, my other hobby horse.
Yeah, I know he's your hobby horse. He's an interesting hobby horse to have. I'm more of an LBJ guy, but I'm curious to walk around. So, okay, enough listeners. You don't need any more nerdiness. We'll see you later. Thank you so much for listening to the Cognitive Dissidence podcast, brought to you by Cognitive Investments. If you are interested in learning more about cognitive investments, you can check us out online at cognitive.investments. That's cognitive.investments. You can also write to me directly if you want at jacob@cognitive.investments. Cheers, and we'll see you out there. The views expressed in this commentary are subject to change based on market and other conditions. This podcast may contain certain statements that may be deemed forward-looking statements. Please note that any such statements are not guarantees of any future performance, and actual results or developments may differ materially from those projected. Any projections, market outlooks, or estimates are based upon certain assumptions and should not be construed as indicative of actual events that will occur.